in this tenders too, the government will tell you how much they want to raise, and then at the end of the auction, they will tell you how much they were able to raise. Sometimes they are able to raise the entire size. Some of the time they raise even more than that. Some of the time they raise less. It all depends on how interested people are in what government is selling. And then normally they also tell you the next auction, the amount of money they will want to raise and what kind of securities they'll be selling. So for instance, you see here that they said that in the next one, they will want to raise 1,041,000, and they want to be selling 91 days and then 182 days, basically. We won't go into these calculations. If you want to get a discount rate and yield on T-bills, these are some of the formulas we use in computing them. So now let's come to capital market. So under financial market, we have done money market. Now capital market, and is a segment of the market that deals with long-term funds. I've said that, or patient funds. If you hear somebody say patient funds, they're talking about long-term. Long-term funds are sometimes called patient funds because they can be held for a very long time. And the two main assets that or mediums through which you raise money will be either debts, loans, debts the same as loans or bonds, and then equity. The risk profile of securities in this market are generally higher than the money markets, and so they offer higher yields than the money market. Okay. So generally, we know that anything that is long-term have risks inherent in it because, as it is said, a bird in hand is worth two in the bush. If there is money that you are supposed to give to me now, I will take it rather than wait for 20 years because anything can happen in 20 years. So generally, investments that are long-term are more risky, and so they offer higher yields or returns to compensate for the risk. So securities in the capital markets side of the financial markets are relatively risky and offer higher yields. Let's look at some of the differences or some of the features of the two markets. So if you take examples, certificate of deposit, treasury bills, and commercial papers are issued in the money market. Shares and bonds are issued in the capital market. Duration, money market up to 1 year, long-term market greater than 1 year. Investment objectives, maintain wealth. So if you have wealth, you want to maintain, not to necessarily capital appreciation, grow it so much, but you want to maintain it, just keeping up with inflation here and there. Money market. If you want to generate wealth, grow it, we want capital appreciation, then you go to capital markets. Okay. Level of risk, money market is low, capital market is high. Level of volatility, money market is low, capital market is high. And you understand if something is long-term, it is volatile because a lot of things can happen within that long-term framework. Liquidity, money market high, capital market low. And I have said that before because the short-term papers are easily they mature early and they can easily be traded compared to the long-term market. So I think the distinction should be clear by now in your mind, the main differences between these two markets. So who are the people also playing in the capital market? The government, through the Ministry of Finance, they come to the market to raise bonds. So the government is a big player in the in the capital market. When a government draws up its budgets, and Sophia talked about budget, when you drop up budget, hello?
Your slides are not moving, please.
Okay. This is where I am. Is it moving now? Can you see it? Capital market participants.
Yes, please, we can see now.
Very well. Okay. So when the government draws up, when you drop up a budget, you either balance it where the inflows are equal to the outflows. You have a surplus where your inflows are more than the outflows, or you have a deficit where your outflows are more than your inflows. When you balance it, you don't have any problem. When you have a surplus, you don't have any problem in the sense that you can invest the surplus to generate some interest or some profits. However, when you have deficit, it means that what you intend to spend is more than how much you are going to raise. So in that case, you need to go and look for additional funding to support your budget, and that's what we call the budget deficit. And we know that as developing economies, most countries run a deficit budget where we are not able to raise enough money to finance our budgets. Once we have drawn up our budget and it's showing a deficit, it means that the difference, it must come from somewhere. You have to go and borrow to augment your resources to be able to deploy the programs that you have earmarked. So when the government draws up a budget and whenever you hear deficit, it means that the government must find a way to raise the additional money. And the capital market is the place where the government goes to do that. So through the Ministry of Finance, they sell bonds, 2 year, 3 year, 4 year, 5 year. Normally we don't do 4 year, we do 2 year, 3 year, 5 year, 6 year, 7 year, 10 year, 15 year, 20 year. So what the basically government comes to do is the government will give you paper and collect money from you and promise to pay you interest over the life of the bond, and then when it matures, they pay you. These days, we don't do paperwork again. There's what we call the Central Securities Depository, CSD, which is like electronic platform where if you have if you have invested in government bonds, it is shown there as a repository of the data of the people who have bought some form of bonds. And so that is where the information is kept. So government uses the capital market to raise money to finance its deficits and also infrastructure. So the government can come and issue bonds worth, let's say, 2 billion, and say we are going to use it to build schools or build roads. And then the government will be paying the interest on the bonds and also pay the bond when they mature. Now, the commercial banks, apart from dealing in the money market space, they also deal in capital markets. Albeit they don't invest too much here, they also deal in the capital market. So when the government issue bonds, they also come to buy some. And apart from they buying bonds, they also grant long-term loan. That is also a form of capital that they are providing to corporates. So granting of long-term loans is also so it's a capital market activity. Apart from that, the banks themselves, commercial banks themselves, they also borrow. Yes, they borrow from development agencies or development banks. So they can go and borrow from African Development Bank and to augment their capital. So that's also a capital market activity. And then the same corporate that we talk about, that they also operate in the money market, they also operate here. One, they come to issue equity or debt to augment their capital. So MTN came to the market in 2018 to sell equity, even though in the case of MTN, it wasn't really because they needed capital. It was a case of one of the shareholders offloading, and also as a way of showing solidarity to the Ghana market, they wanted Ghanaians to hold some of their shareholding, so they came to sell. But for instance, MTN also raised what they call the medium-term note, MTN. It's coincidentally, the company is called MTN. The paper they came to issue is also called MTN. MTN simply means medium-term note. So MTN came to issue a medium-term note. It's the same as bonds, really, to raise money to augment their capital. So that's how companies participate in the capital market. When they need money, they come to raise money, either in a form of equity or debt. The other way is that if they have patient money to sit for a long time, there's nothing also wrong for corporates to buy some bonds and put on their balance sheet just to make the interest on those bonds. But I mean, when corporates come to the market, it's because they are coming to raise capital. So we have a lot of companies that have done that through the Ghana Stock Exchange: Cobank Ghana, GCB, MTN, Fanmilk, Guinness Ghana Limited. A lot of companies over there that have come to raise capital to augment their capital. And that is allowed in their participants in the capital market. Institutional investors, they are appearing almost everywhere: pension funds, insurance companies, and fund managers. These are people you give your money to, invest your money with, or you entrust your money with to especially fund managers to invest for you. When they take your money, they invest in the capital market as well. So for instance, pension funds are long-term investors. So when Senate takes money from employees on every month and they're investing, they put a lot of them in the capital market in the form of buying bonds, buying shares, so that in future when people retire and they need to pay them, some of these bonds will be paying interest to them to be able to pay these pensioners that have gone on retirement. So that's what pension funds do. They also invest in the capital market. Insurance companies, especially the life insurance companies, also invest a lot in the capital markets. And of course, fund managers managing collective investment schemes also do the same thing and invest a large portion of their monies in this market. So I'm also going to show you some issuance notice. So this is, you can see, dear investor, Republic of Ghana, March 2022, 5-year Ghana cedi denominated treasury bond issuance announcement. So now when the government is going to issue bonds, this is the first circular they send. And it tell investors that they are going to issue bond. In this circular, you see that they have told you that the person that is going to raise the money is Republic of Ghana. March 2022. That is when they are going to issue it. And then they are going to issue a 5-year Ghana cedi denominated treasury bond. And then issuer, they say Government of Ghana. Size, TDB means to be determined. And normally there's an issuance calendar that they give us, so you have an idea what they are going to issue. Issue treasury bond, the notes and bonds. So the issue year, they will tell you maturity to mature 2027. So if you are in 2025 and something is mature in 2027, it is a 5-year issuance. Security, senior unsecured. Principal payment, bullet. Bullet means that the way they are going to pay it is when it matures, they pay it once. There's another structure we call amortized. Amortized or sinking. The amortized one means that they won't pay it at once. For the life of the bond, they will be spreading the repayment of the principal. But the bullet means that they will wait to the last day of the last year to pay you the principal, but they'll be paying you interest in the case of Ghana every 6 months. And then distribution is marketed to resident investors, open to non-resident investors. Yes. So who, in other words, who can buy? Resident investors. So anybody who is resident in Ghana can buy. And then anybody who is not resident in Ghana can also buy. That is open to non-resident investors. And I have to say that this is one of the means that government use to attract dollars into this country. When government needs, hello? Okay. Yeah. So when foreigners come to invest in these cedi bonds, of course, foreigners don't spend cedi. So when they are coming, they come with dollars. Come and change the dollars and buy our cedi bond. By so doing, they introduce dollars into our economy. So this is one means by which government attracts dollars into our economy, selling local cedi bonds to foreigners. Denomination, each bond shall have a face value of 1 cedi, and so on. I don't think I have to go through all this. And then there are the other page, they will give you the other information. They say the offer period is Tuesday. That is when they release the circular. By March, they call something book build. Book build, that it means that okay, let me explain this. On Tuesday, 8th March, they say release of initial pricing documents or guidance. Initial pricing guidance. Initial pricing guidance is they are going to issue a bond of 5 years. Before people start bidding, they will tell you the interest rate, or what we call the coupon rate, that they are going to offer. Not, they will give you an area. This day they will say maybe 20% area. In other words, the rate will be either 20% plus or minus. So they will release the initial pricing guidance. And then book build, in other words, from the book build starts from 9 a.m. In other words, from 9 a.m. on the set date, that is Tuesday, the people will start building for the bond, and then they will issue revised and final pricing guidance. Before the offer will close, the government will come back to tell you in concrete terms the rates that they are offering on the bond they are selling. The reason why they do this is there is something they call the market sounding, where before the offer will come, they'll be calling some of the investors and be saying, okay, we are coming to sell 5-year bond. Where do you think the rate should be on it? Some will say, oh, 19%, 20%. Then they'll sit down and look at all the information they got and then decide on what is the final pricing guidance, and then they will communicate it to the market, and then they will collect the money from all the investors who wants to invest. Now, if you remember, when we're doing the T-bills, I said that they use the weighted average yields or rates, where they serve on first come first serve basis in terms of who has the lowest yield. This one, it has to be only one price or only one rate. So maybe I should have said when I was doing the T-bill side that T-bill rate is not the same for everybody. It depends on where you bought it from, because if they are doing so, for instance, in the scenario I gave, Joshua bought his T-bill as 10%, Sophia bought it at 11%, and Kofi bought it at 12%. So if Kofi is the one who bought the T-bills on your behalf, you get 12%, but if it's Joshua, you get 10%. However, when it comes to bond, it's not like that. There's something they call the single clearing system, where they will only offer one rate to everybody. So if that one rate you don't want it, then you are not giving the bond at all. So if government's 5-year bond clears at 20% and I bid at 21%, either I change my bid rate to 20% or I don't get the bond at all. That is how this is done. Okay, single clearing. But for T-bills, they do lowest rate first, the next lowest rate. So everybody will get. If your rate is so high, you may not get it. But at least until they get the size of issuance they are looking for, there may be 2 or 3 different rates that they will pick. But for the bond, that is not done. It is single clearing system. I think this, the Fifi mentioned it, all successful bid will clear at a single clearing level. Yes, so that is how that is done. And then, okay, so this is what I was talking about. After the first information comes, the next information that will come is say the market specialists, ABSA, Blackstar, Cowbank, blah, 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 are pleased to announce initial pricing guidance, IPG of 40.40 area. What this means is that the rate that they are going to offer on the 5-year bond will be 20.4% or above or below. So in other words, it can be 20%, it can be 20.4, it can be 20.6. So it means that it will be around this area. So normally, if you see this, you know that it can be 20%, it can be 20.6, and so it sort of gives you an idea where the yield will clear. So if you think that the 20% is below your 20.4 is below your expectation, maybe you can decide not to bet at all. But if you think it's around the area you want, you can decide to bet slightly up or slightly below it. Bearing in mind that you could lose the bid if your bid is so high, the rate you are demanding is so high, you could lose it entirely. So this is how they inform us of this. This is what we call the initial pricing guidance, IPG, that will show you where the government intends to sell the bond. Then after they have issued the bond, they will show you this page. I hope you are seeing it. Okay, this is it. So after they have issued the bond, they will show you this page. Now, what is on this page is, dear investor, Republic of Ghana, March 2022 5-year CD denominated treasury bond, issuance summary, tender 1789. Now, every issuance government does, they give it a tender number. So this is the unique number that refers to this security that was issued. Then they give you a summary. Issue size, in other words, this is how much they were able to raise, 862 million Ghana cedis. ISIN, I told you what ISIN is the security ID. ISIN number is this. Security description is a 5-year Ghana cedi treasury note, and you see this code here, that is the unique security ID. GOG means Government of Ghana, BD means bonds, 080327 means that it will mature 8th March 2027. And then this is the unique tender number that was given to this security. And the last number is the yield or the interest rate or the coupon on this bond that was sold. So if you remember, the pricing guidance said 20.40. And mind you, that was initial pricing guidance. It means that even though initially they said 20.4, it's closed or cleared or settled at 20.75. So this is the interest on this bond or the coupon on this bond. The last number here, 20.75. So if you see this security ID, this is what it tells you. It tells you whether it's a bond, it tells you when it will mature, it tells you the tender number, and it tells you the coupon rate. Then it says listing. It will be listed on the Ghana Stock Exchange. The law that governs this is Ghana law. When it will mature, March 8, 27. Trade date 10th. Settlement date is 14th March. When we say settlement date, it means that that is the day that if you bought the security, you are supposed to pay money. You are supposed to pay for it. Settlement date. That is the 14th March. And then the other information, it tells you that the final pricing was 20.75. Initially, it was 20.4. This is the amount of bits that was tendered. In other words, people brought 862 million, and then this is the bid that was allotted. It means that, and the government accepted everything. So this is how bonds are issued by the Republic of Ghana, and the kind of process that we go through in the markets. I know time is fast spent. Let me try and do primary and secondary market, then probably we will end it there. So primary and secondary market. So I've explained financial markets into two, money market and capital market. I've shown you how the players in both markets, how T-bills are issued, how bonds are issued, the kind of information they look at. Now, the financial market can also be classified as either being secondary or a primary. And it's simple. When you say a primary market, it means that the name primary, I'm sure we are all familiar, first level. When we say a primary market, is a market where security is first issued and the process of the issuance go to the company issuing it. So like I told you, Ecobank Ghana came to the market to issue, I think that was 2006, to issue shares. The first time Ecobank Ghana is coming to issue shares to take money into the business is primary market. Now, after they have issued it, if you want to buy some of the security, you won't be able to buy from Ecobank Ghana, but you'll be able to buy it from another investor who bought it when it was first issued. When you are buying it from the other person who bought it first, when it was first issued, you are buying it in the secondary market. At that time, you are not buying from the underlying company, Ecobank Ghana, but you are buying from the secondary market. So the main distinction is that primary market is when it is first issued, and then the process of the issue goes to the company. However, for secondary market, it is when where the security issued is traded to provide liquidity, and where the process from the trade goes to the selling investor. So example, Young Investor Network comes to the stock market to issue shares to expand its business. It has issued it. When it issued, Joshua bought, Kafui bought, Kofi bought. They are all holding shares. I didn't buy some. Then after 2 years, I see that Young Investor is doing very, very well. I want to buy some of their shares, but they have issued the shares already, so they can't sell shares to me. But I think they are doing very well, so I want to buy some of their shares. So Joshua too says that I have Young Investor shares. I need some money to buy a house, so I want to sell parts. Maybe Joshua bought 100,000 shares. I want to sell part of the shares. Joshua will go to the secondary market to sell, and then I'll meet Joshua there. Of course, not physically. When you are in the secondary market, you deal through brokers. So Joshua will go to a broker and says that I want to buy Young Investor shares. And then the broker will say, how many shares? I want to sell. Joshua says, I want to sell. How many do you want to sell? Joshua says 50,000 shares. The broker will take the order. And then the next day I also come there without knowing that Joshua intends to sell. I also go and say, oh, I'm also looking for Young Investor shares to buy. How many? I say 60,000. They say, okay, put your order down. I put it down and I go. And they ask me, what price do you want to buy it? Maybe when Young Investor was issuing, they said they issued it at 1 cedi. But because Young Investor is doing so well, the price has gone up to 1.5. So I tell them that I want to buy it at market. When you say you want to buy it at market, we are telling the broker that the price that is on the market, that's how much I want to sell it. So the broker says, okay, Mr. Bossman, you want to buy 60,000 shares. Joshua is selling 50,000 shares. So they sell Joshua's 50,000 shares to me and I pay. When I pay, the money will not go to Young Investor. It will go to Joshua. You see the difference. So in this case, the process of the trade is going to the selling investor. But when Joshua was buying it the first time and Joshua paid for the 100,000 shares, the money went to Young Investor. So that is a key difference between the secondary market and the primary market. The secondary market is meant to provide 1, liquidity, 2, price discovery. Liquidity means that after you have bought young investor shares, if there is no secondary market, if you want to sell, you struggle. You have to virtually go around town and play your gong saying that I'm selling young investor shares, so who buy? That is a laborious process. You can't do that. So what the secondary market offers you is a place where you can come and say, I want to sell my shares, and then there will be a broker there to help you. So that is the liquidity we talk about, help you to sell your shares and get your money back. What next secondary market gives you is what we call the price discovery. Secondary market helps to reprice the shares of the issued company. What happens is that as the company is doing well, the current investors will be pricing in the profitability and the outlook of the company into the shares. So that's why I said that young investor may have issued the shares as 1 CD, but because young investor is doing well, maybe the shares will be trading at 1 CD 50 pesos. So it's because of the secondary market that you'll be able to see this price. If the secondary market was not available and you have to meet, Bossman and Joshua have to meet physically, Bossman and Joshua have to sit and negotiate the price. And the one that has good negotiation skill may be able to hold the better end of the deal. So what secondary market does is to help you in terms of pricing your security or your investments. And I'll do this final one and probably we can end it here. International capital markets. Okay. Now, apart from capital markets, apart from what I've described, there's what we call international capital market. And I brought this slide in because of these days we hear about Eurobond. So what is these days the world is becoming small and we are together to the extent that we do things together. So you can be a company here, you go and raise money abroad, and vice versa. So before for a very long time ago, what companies were doing is that if you had a company that was very strong, you could go to another company and go and raise capital to finance your business, provided people have belief in your company. So easily, a German car maker can go to the United States and go and sell bonds in the United States in dollars, and then raise the money and bring it to Germany to come and work. Okay. And that was what they used to call the foreign bonds. So a German company goes to US, raise bonds, say I'm a car maker in the Germany, I'm the one making Mercedes-Benz. People in US are driving Benz, they know how good it is. So they will give you money to go and invest in your business. So even though Germany may be spending euros, they go to US, go and sell dollars and go and raise dollars and bring it to Germany, convert it to euros and use it to invest in their business. That is foreign bonds. Now there's what we call the euro bonds. Okay. Now these are bonds that are denominated in currency other than the currency in which it is sold. Okay. For example, government of Ghana issues a bond denominated in dollars and sold generally in the international market. Ghana, we spend cedis. So if we issue a bond in dollars, that is an euro bond because it is not a currency of the market of the issuer. So that is euro bond. So in the last 3-4 years, every year around February and April, government has been issuing euro bonds, where government of Ghana, whose currency is cedis, issue dollar bonds in international markets to raise money to support budget deficit. Euro bonds. Of course, this year we have lost access to international markets, so we've not been able to do that. But that is what the euro bond is about: issuing bond denominated in currency other than that of the country in which it is sold. Okay. So we are in Ghana, we do dollar bonds and we allow international investors from anywhere around it. That is an euro bond. There's also euro currency, which is also similar to the euro bonds. These are foreign currencies deposited in banks outside the home country. So foreign currency, we are in Ghana, we spend cedis, but you have dollars and then you deposit it in the bank outside Ghana. That is euro currency. The most important part of euro currency is euro dollar, in which US dollars are deposited in foreign banks outside the US, like just what I said. Okay, US dollars are deposited in. Mind you, the word euro is very confusing. It makes it seem like it has something to related to the currency euro, but it has virtually no relationship. Look at what I've written down here. So note that the word euro connects